Let's talk about PayPal. PayPal. Sorry, PayPal. Let's talk about PayPal. It has been a pain to own the stock, let's be honest, right? If we look at its performance year to date, has done basically nothing. It's down 2.6%. Year over year, down 13%. If you're holding this for a long time, let's say 3 years, you're down closer to 80%. If you're a long-term shareholder, you're down, well, in the last 5 years, you're down closer to 50%. So definitely you're feeling the pain. Of course, this is unless you've bought along the way. Right now, we are back under $60, which means market cap $62.55 billion, forward PE 14.4 times. Basically, priced for close to zero growth. If we look at what the analysts are expecting, sales growth year over year of around 8% or so. EPS growth for fiscal 2024, we're taking a hit, down 19%, but then a reacceleration of around 10% for the next 2 fiscal years. Now, as we've seen in previous reports, this company is now generating a bit more free cash flow as well. Now, if we're comparing PayPal today to its 5-year mean, valuation-wise, forward PE, EV to EBITDA, price to sales, price to free cash flow, price earnings to growth, we can clearly see, of course, there is that period of the pandemic where things were way more expensive, where growth was higher than today as well. So take that into consideration. But all in all, we are much cheaper than before, actually almost 50% cheaper than before on a forward PE, EV to EBITDA basis. Price to sales, 1.9 times, not that expensive. Price to free cash flow, that's in the last 12 months, only 12.6 times. So again, this is a very cheap stock in my opinion. This is all my opinion. Price earnings to growth, 1.68. We're not done because as a shareholder of PayPal today, you basically own a bigger chunk of the pie than before. Since 2020 or so, they bought back close to 11% of their outstanding shares. Free cash flow per share is going up throughout the years. There were some years, of course, there was that push from the pandemic, so free cash flow went up, then went down a little bit after the pandemic. But as we've seen last quarter, I think free cash flow could go back up. And overall, free cash flow, I've put here the last 10 years. Of course, it has grown in the last 10 years, but more recently it was more flat-ish. Again, there was the pandemic, so free cash flow was higher than normal. Then after the pandemic, it took a hit. But right now we can see that we're making our way back up. And all of that happens at the same time when there is way more competition, right? Because everybody's talking about the competition. And it's true, there is more competition. Apple Pay, Google Pay, Amazon Pay, Shopify Pay, all the other solutions out there. It's true, way more solutions today than ever before. And that's why we've seen take rate come down. But overall, free cash flow still remains stable and in my opinion will be more than before, despite all the competition, by the way. Then if we look at what has happened. So total revenue, 5-year CAGR, 12 months, 13.87% currently. EPS, 5-year growth rate, these are estimates, forward-looking, 8.58%. So definitely not a super high growth company, right? EPS growth, not even double digits. Although, again, I think they might surprise some analysts. So far, so good, because we're going to continue just a tiny bit. Just want to make the comparison. It's not apples to apples, but just from a stock market perspective, it might make sense to some of you. Before doing that, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. We'll really appreciate that. A lot of you are not subscribed to the channel, so we're trying to reach 50,000 by the end of the year. So just hit that red button. Would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's go back here. I will compare PayPal. I know I'm going to sound crazy to some of you, but I want to compare PayPal to Apple. Why is that? Well, I'm going to explain exactly why. Of course, again, it's not apples to apples. No pun intended. Yes, I know. Apple, one-of-a-kind company. Yes, Apple, way more profitable than PayPal, etc., etc. I know. But I just want to show you from a stock market perspective. Apple, the forward-looking, right? 5-year EPS growth rates, 10.72%. So a little bit higher than PayPal. If you look at total revenue CAGR, this is 5 years, 8.10%. So lower than PayPal. Of course, again, more profitable, extremely dominant company, etc., etc. I understand. But is this why? Are those numbers why Apple should be trading at a forward PE of around 30, where PayPal right now is at 14.4. You understand what I'm saying here? Apple basically 2x the forward PE of PayPal, despite, from of course a backwards looking metric here, the growth rates for sales less than PayPal, forward looking EPS a bit more than PayPal. But both companies are in both companies. PayPal is actually still growing. Apple, as we've seen, has not been growing at all in recent quarters. But of course, the expectations are that the free cash flow for Apple is more secure than something like PayPal. Apple's dominance is more secure than something like PayPal, and so you get a higher PE. But still, let's say, okay, fine, that's a good reason. That's, by the way, also one of the reasons why Coca-Cola has a high PE as well, because the future free cash flow are more secure than another tech company. But let's say, okay, we understand that. So maybe PayPal should not be trading at 30 times forward PE. But I think it should be trading at higher than 14.4. How much higher? How much higher depends on what type of investor you are, what type of forward-looking view you have on the company. But in my opinion, it should be trading in the 20s. So definitely much higher than the price we're at today. And that's without seeing the business move one bit just yet. Just purely looking here on taking that multiple and making it a higher premium. That's about it. Plus, of course, then eventually you can take into consideration the fact that they're buying back 8% of the company or so each and every year, thanks to the stock price not moving, them generating more free cash flow, then buying back more shares. So yeah, you can already see why I think PayPal shares should be worth more in the future or even right now. That's just me, of course. Of course, I'm biased, I'm bullish on PayPal, but if you've been watching the videos for quite a while, you know we've done live stream, we've talked with Roy as well, others came on the channel, we talked about PayPal. We're very, very transparent with what we think about PayPal. If we don't see any improvements, we're gone. We're not just in PayPal for the sake of being in PayPal. No, at the end of the day, you want to make money. We think PayPal is extremely undervalued. We still believe that new management, as you will see in just a second, that new team is going to be a great team, better than before, going to move this business forward and actually exceed what PayPal has done under Dan Schulman. That's our expectations. Of course, if that doesn't happen, then we see no reason to stick around, just like with other companies. If the thesis does not work out, if the thesis is broken, then of course, we jump ship. Like I said, a la Theon Greyjoy, we jump ship. That's it. Now, moving into the next part of the video is the building of a superstar team. Management team, CEO came in, basically a whole new group of people. So let's look at what has happened since then. Geoff Seeley joins PayPal as Chief Marketing Officer. Seeley was, apologies if I mispronounce the names. He was most recently the Global CMO and Communications Officer at Cash App and Afterpay. At PayPal, he will be focused on making sure the PayPal and Venmo value propositions are clear, compelling, and simple for customers. He will also focus on bringing new energy to the PayPal and Venmo brands by leveraging the company's innovative history, powerful product portfolio, and continuing to build on customer trust. We know that PayPal and Venmo, the fact that it's all under the same company and not really working well together, is a huge miss from the previous management. Very, very happy to see that they're taking this very, very seriously. Alex Chris also keeps on talking about Venmo, the power of Venmo, so definitely excited with this. Geoff brings over 25 years of expertise in transforming global consumer and B2B brands by leveraging cutting-edge digital and performance marketing and building strong teams focused on enhancing brand awareness and engagement with customers. This is also of extreme importance, especially now that there is more and more competition in those markets. Moving on. PayPal names Amy, I'm not going to butcher the last name, as Chief Corporate Affairs and Communications Officer. Amy joins us from Wells Fargo, where she was the Chief Communications Officer. Amy will be responsible for leading the global communications team and social impact and sustainability efforts across PayPal's family of brands, including Venmo. Okay, I guess, nice addition. Moving on to the next one. This is a name that you're probably familiar with since he comes from SoFi. So PayPal names Aaron J. Webster as Executive Vice President, Chief Enterprise Services Officer. Aaron will have end-to-end accountability for global financial crime and fraud prevention programs, regulatory and government relations, and risk and compliance management. Aaron joins PayPal from SoFi, where he was most recently Chief Risk Officer, Global Head of Operations and Latin America. Moving on to the next one. PayPal names Steve Winokur as Chief Investor Relations Officer. This is something that we're already seeing the positive effects from, by the way. So he jumps PayPal from General Electric, where he most recently served as Chief Investor Relations Officer and Group Vice President for GE Aerospace. Winokur will report to Jamie Miller, CFO, and will be responsible for communicating the vision and progress of PayPal's transformation to the financial community. We've already seen better reporting by PayPal. This is great, by the way, from a retail investor's perspective as well. You get more information, even if they remove something, if there is an explanation, if they add something else to those reports, it's always great. Then, more recently, and I think this is going to be a huge deal, PayPal announces new leaders to build new advertising platform and accelerate consumer product innovation. So, with regards to the advertising platform specifically, PayPal's long-standing relationship with millions of consumers and merchants make the company uniquely positioned to create an advertising platform that is rooted in commerce. So, the new person coming in, Greeter, I don't know how you pronounce that, will join the company to build an advertising business that will help make merchants smarter to sell more products and services effectively, as well as enable customers to discover more of what they love. The advertising business, which will include PayPal Advanced Offers platform, will use customers' insight to build a dynamic, truly personalized platform that will drive better advertising spend performance for merchants while delighting customers with compelling offers. Of course, it makes sense, since PayPal has so much data on the merchants and on the customers as well, how they pay, when they pay, why they pay, how fast, etc., etc. It makes sense. You want to spend your ad dollars to get the most ROI. Your return on investment has to be high. And since PayPal has probably one of the best data out there when it comes to spending, it's a no-brainer. Now, he comes from the advertising industry with more than 20 years of experience. He joins PayPal from Uber, where he was the vice president general manager of Uber Advertising. Under his leadership, Uber Advertising grew to a $1 billion business with more than 500,000 advertisers globally. In my opinion, should be relatively easy to achieve that at PayPal. And of course, with regards to advertising, high margins comes down to the bottom line. A no-brainer. If Uber can reach $1 billion in that segment, I think PayPal can do much better than that. I don't think they will reach the levels of Meta, or not even close to that, but it can be $1 billion business for them for sure. And by the way, if you look at the share of US digital ad spent by company type, you have, of course, the biggest chunk here, Meta and Google. But as you can see, e-commerce has been taking a larger chunk as well. Now that you can directly target from an e-commerce perspective, I think a company like PayPal will definitely benefit from that. And then more recently, PayPal names Srini as Chief Technology Officer. He will lead the development and implementation of technology across the entire PayPal ecosystem, including analytics and data science, AI and machine learning, information security, infrastructure operations, and product engineering. He joins PayPal from Walmart, where he most recently led the US Omni platform and tech organization. At Walmart, he led a team to build platforms, features, and capabilities to support the retailer globally. And I think it's still the biggest retailer out there. Maybe Amazon surpassed it, but I'm not sure. So definitely another great hire. So you can understand why I think they are building a dream team here. Moving on, and a quick recap of what happened last quarter, just basically on TPV. So the mix across PayPal's payment platform, we can see that branded, which is high margins, branded has come down, right, as a percentage of total, which is why margins got hit. Why is that? Well, because PSP, unbranded, Braintree, they have been taking a larger chunk of that. It's growing much faster, but it is lower margins. They're pricing that pretty aggressively to drive adoption, but I do think that in the long run, we've seen platforms like Adyen doing extremely well. In the long run, I think this is going to be a big positive for the company. Of course, in the short term, it's a margin hit. Now, one of the things that was launched this year is, of course, Fastlane. So we've got two comments with regards to Fastlane and how positive that will impact the business. One extremely positively from Dan Dolev, always a bull when it comes to fintech. So the offering could drive $1 billion to $1.5 billion boost to PayPal's transaction margin dollars over a medium-term horizon. That would translate to upside in the range of 5 to 10%. Dan Dolev lifted his price target on PayPal shares to $90 from $68. It's based on a higher target multiple, now 19 times estimates 2025 earnings per share versus 15 times previously, and more optimistic earnings estimates. Basically what we've talked about at the start of this video. The moment you're ready to put a higher multiple on a stock for various reasons is the reason why the stock should be higher. Then you end by saying, we believe the higher multiple is deserved amid new data showing less pressure on branded business as well as strong early trends in the fast lane opportunity. Then more recently, we had another analyst from JP Morgan here, but he says that he sees up to $250 million incremental revenue from PayPal Fastlane by fiscal year 2026. He said that the smart guest checkout known as Fastlane identifies 70% of customers, raising conversion rates from 45-50% to 80%. Of course, this is not just a great thing for PayPal, but this will drive adoption because the people that use it, well, of course, your conversion rates are much higher, which means you as a business will make more money. The analyst estimates this could drive $100 to $250 million in incremental revenue by fiscal year 2026, translating to a 70 to 170 basis points uplift in their transaction margin dollar estimate for PayPal. He explains that PayPal's Fastlane, with its ability to convert guest checkout into more lucrative branded transactions, offers a significant growth opportunity. He projects that each 1% in branded penetration of unbranded guest checkout flows through Fastlane could yield approximately $51 million in net revenue. Again, I think more and more analysts will start to notice the transformation that is happening at PayPal. And by the way, PayPal does not have to reinvent the wheel. They just have to come out with solutions that are on the same level as all the others, maybe a tiny bit better. Because PayPal has been lagging behind for the last couple of years, and that's why it has been losing a little bit of market share. That's why take rate has come down, because the competition came in and suddenly saw, look, our solutions are much faster than PayPal. What are they doing? Okay, let's eat some market share here and there. Now with Fastlane, it's not a, let's say, revolutionary product because Apple Pay, Shop Pay, all of the rest, they're also doing it quite fast. So it's basically bringing PayPal back in 2024 instead of still being in 2016, 2017 or so. Just so we're clear. But right now, it seems like the market is still in the show me what you've got mode. Of course, we got a big red candle because of Apple's announcement last week, which in my opinion shouldn't really change anything because it's the same thing. Instead of pushing the button or tapping on your phone, send money, you can now touch one phone to the other. Wow, truly innovative stuff from Apple. I think it's an overreaction, but of course, with PayPal, it's still in the stage of show me what you've got, show me that you can continue to grow, show me that all your, let's say, new announcements are improving, are making sure that margins are going to go up, etc., etc. So yes, currently it's PayPal. Hopefully, in the long run, it will be Pay Me Pal. So right now we're back just under $60. The 200-day moving average and the 50 and the 20 are all at around $63. RSI still pretty neutral. So overall, that's about it. PayPal right now, Pay Me Pal in the future. I think it's extremely cheap and undervalued right now. And I think it's going to at least reach triple digits later this year. That's just my prediction. Leave yours down in the comment section below. If you don't like the company, if you don't like the stock, you don't have to buy it. So don't leave silly comments in the comment section below. Like, subscribe, hit the notification bell, and I'll see you all in the next one. Bye-bye.